If you're just starting out in investing and you're not sure where to begin, index funds might be the single most important thing you learn about today. In this video, we'll explain exactly what an index fund is, how it works, and why some of the world's greatest investors swear by them. What is an index fund? An index fund is a type of investment fund that tracks the performance of a specific market index. An index is simply a list of companies grouped together. One of the most famous examples is the S&P 500, which tracks the 500 largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Google, and Tesla are all part of the S&P 500. Instead of picking individual stocks, an index fund automatically invests in all the companies within that index. So when you invest in an S&P 500 index fund, you instantly own a tiny piece of 500 of the biggest companies in America at once. A simple example. Let's say you invest £500 into an S&P 500 index fund. Your money is instantly spread across 500 companies, from technology giants like Apple and Microsoft to healthcare leaders, financial institutions, and consumer brands. If those 500 companies collectively grow in value, your investment grows too. You don't need to pick winners. You own all of them. Other well-known indices. The S&P 500 is the most widely followed, but there are others worth knowing. The Nasdaq 100 tracks the 100 largest technology-focused companies in the US, including Apple, Nvidia, Meta, and Amazon. It tends to grow faster than the S&P 500, but also carries more risk due to its heavy tech concentration. The Dow Jones Industrial Average, often just called the Dow, tracks 30 large, well-established American companies like Boeing, Goldman Sachs, and Coca-Cola. It's one of the oldest and most recognized indices in the world. The MSCI World Index goes even broader, tracking over 1,500 large and mid-sized companies across 23 developed countries worldwide, giving you truly global diversification in a single fund. Active versus passive investing. To understand index funds, you need to understand the difference between active and passive investing. Active investing means someone, a fund manager, is constantly buying and selling stocks trying to beat the market. This takes skill, time, and comes with higher fees. Passive investing means simply tracking the market. No stock picking, no constant trading. Index funds are passive investments. They don't try to beat the market. They aim to match it. And here's the surprising truth. The majority of actively managed funds fail to beat the S&P 500 over the long term. Over a 20-year period, studies show that more than 90% of active fund managers underperform a simple S&P 500 index fund. This means most professional fund managers, despite all their expertise, do not consistently outperform a basic index fund. Why are index funds so popular? There are 4 main reasons index funds are loved by beginner and experienced investors alike. The first reason is diversification. Because you own hundreds of companies at once, your risk is spread. If one company like Netflix or Meta has a bad year, it has very little impact on your overall investment. The second reason is low cost. Index funds charge very low fees because they don't require active management. For example, one of the most popular S&P 500 index funds, the Vanguard S&P 500 ETF, charges an annual fee of just 0.03%. That's 3 cents for every $100 invested. Over decades, lower fees make an enormous difference to your returns. The third reason is simplicity. You don't need to research individual stocks, follow company earnings, or make complex decisions. You simply invest regularly and let the market do the work. The fourth reason is strong long-term performance. The S&P 500 has averaged around 10% per year over the last 50 years. That means £10,000 invested in an S&P 500 index fund 30 years ago would be worth well over £170,000 today, simply by staying invested and doing nothing. What is dollar cost averaging? One of the best strategies for investing in index funds is called dollar cost averaging. Instead of investing a large lump sum all at once, you invest a fixed amount regularly, say £200 every month, regardless of what the market is doing. When prices are high, your 200 buys fewer shares. When prices are low, it buys more. Over time, this smooths out the impact of market volatility and removes the pressure of trying to time the market perfectly. Are index funds risk-free? No investment is completely risk-free. If the overall market falls, so does your index fund. During the 2008 financial crisis, the S&P 500 dropped by nearly 50%. During the COVID crash in 2020, it fell around 34% in just a few weeks. However, in both cases, the market fully recovered and went on to reach new all-time highs. The key is to stay invested and not panic sell during downturns. Who are index funds best for? Index funds are ideal for long-term investors who want steady, reliable growth without the stress of stock picking. They are perfect for beginners, busy professionals, and anyone who wants to grow their wealth without spending hours analyzing the market. Even legendary investor Warren Buffett has repeatedly said that for most people, investing regularly in a low-cost S&P 500 index fund is the smartest long-term strategy available. He's even instructed that after his death, 90% of his wife's inheritance should be invested in an S&P 500 index fund. Final thoughts. Index funds are simple, affordable, diversified, and historically effective. They level the playing field, giving everyday people access to the same broad market returns that used to be reserved for the wealthy. If you take away one thing from this video, let it be this: you don't need to be an expert to invest wisely. A simple, consistent investment in a broad market index fund like the S&P 500 is one of the most powerful financial decisions you can make. At MarketIQBasics, our mission is to make investing simple and accessible for everyone. If this video helped you, please like, subscribe, and share it with someone who needs to hear it. See you in the next one.